Welcome to Money for the Rest of Us. This is a personal finance show on money, how it works, how to invest it, and how to live without worrying about it. I'm your host, David Stein. Today is episode 530, and it's titled Mining and the Global Race for Critical Minerals. This week on the show, we share a fascinating interview that FEG's Greg Dowling conducted with two co-founders of Kinterra Capital, a private equity manager focused on the mining industry. The two principals are Cheryl Brandon and Kamal Toor. They both have decades of experience investing in the mining industry. Here are some of the topics covered in the discussion. How mining and mineral processing work. What are critical minerals? What is the driving demand for them? And will it continue? How the rise of passive management has led to an underinvestment in mining. How to reconcile care for the environment and the need to mine critical minerals. What are the attributes that contribute to successful private capital investments? And finally, why querying ChatGPT is insufficient to get up to speed on an investing topic and what to do instead. I believe you'll find this discussion enlightening. I certainly learned a lot. Before we get started with the interview, let me share some words from this week's sponsor, Delete Me. Right now, the headlines are chock full of data breaches and regulatory rollbacks, making us all vulnerable. But you can do something about it. Delete Me is here to make it easy, quick, and safe to remove your personal data online. I've been using Delete Me for a number of years now. They just sent me my latest personalized privacy report, showing what info they found about me on the internet, where they found it, and what they removed. You see, Delete Me does all the hard work of wiping you and your family's personal information from data brokers' websites. And they're not just a one-time service. They're always working for you, constantly monitoring and removing the personal information you don't want on the intranet. So as someone that has an active online presence, privacy is really important to me. And that's why I continue to use Delete Me. I've been delighted with their service in keeping my personal information off the web. So take control of your data and keep your private life private by signing up for Delete Me, now at a special discount for our listeners. Get 20% off your Delete Me plan when you go to joindeleteme.com/David20 and use promo code David20 at checkout. The only way to get 20% off is to go to joindeleteme.com/David20 and enter code David20 at checkout. That's joindeleteme.com/David20, code David20. Now, here's Greg Dowling, Cheryl Brandon, and Kamal Toor.
Kamal and Cheryl, welcome to the FEG Insight Bridge. Would you mind introducing yourselves and Kinterra?
Well, first, thanks, Greg. It's great to be here. We really appreciate the invite. I'll kick it off. My name is Cheryl Brandon. I'm one of the co-managing partners and co-founders of Kinterra Capital. Been in private equity in the resource and mining specific sector for the last 16 years and have been in asset management for 21 years. Kinterra Capital is a private equity fund that's focused on investing in and advancing and developing critical materials and associated infrastructure in stable jurisdictions for supply chains, which is a really important topic today. We're really excited to talk more about our strategy and give you some insight into the Kinterra opportunity. And I'll turn it over to Kamal for his background.
My name is Kamal Toor. Thanks so much for having us on the podcast. Hopefully your listeners find it useful and insightful, and happy to share our thoughts on our space. My background is very similar to Cheryl's. I'm one of the co-founders of Kinterra Capital, co-managing partner there. And prior to Kinterra, I also spent 16 years in the mining PE space. And today at Kinterra, we're less generalist and more focused on just the critical materials that are necessary both for industrialization as we move forward, but also for the modern economy. And as Cheryl says, we focus specifically on finding those materials and investing in those materials in stable jurisdictions.
First question, what are critical minerals?
It's a great question. So critical minerals are defined as minerals that are essential, as well as there's typically a high risk of supply disruption associated with those assets. They're used for everything, whether it's industrialization, the modern economy, defense, and the specific critical materials that Kinterra targets is copper, nickel, magnetite, and manganese are the top four. There are 12 critical materials in total that we invest in. Again, it's really important to develop these materials as they get integrated into the supply chains for electric vehicles, for battery energy storage systems, renewable power, the power grid, which we'll talk more about, but is really an important aspect of what's happening broadly with the electrification trends. There's a need to expand the power grid in the West. Essentially, it's the upstream aspect of all supply chains. If it's not grown or mined, it doesn't exist. And that's how we think about it.
Let's pull on that string a little bit more. I mean, you hit on a few of the trends, but you can put some context around that kind of supply and demand. I mean, yeah, we've always had industrial needs. Like, why now?
It's a really good question. I think there's a layering effect to that and an iterative effect to that. So first on industrialization, to the point that Cheryl's made, is for sure a base case foundational use of these critical materials. We've seen the development of the US and the West in the last 25 years. We've seen the industrialization and the modernization of China. And much of the commodity story has been the Chinese growth story. And in China today, Greg, the per capita base metals consumption is at 40 kgs per person. When you look at the other emerging markets, ex-China, they're at 2. So if we see the same trajectory that we've seen for China in places like India and Brazil and other places like that, you're going to get a pull on those critical materials. And I think that's one element of what's going on now. One, our global population is growing. 2, China continues to grow and emerge. And then following China, coming back to the layering and iteration, you have India and Brazil and others pushing behind that. And so that's the industrialization side of it. And the base case use of these materials, I think what's really changing today is in addition to those use cases, we are fundamentally changing aspects of our economy. The layering of the modern economy on top of existing industrial use cases is putting a more acute demand pressure on some of these minerals. And Cheryl's mentioned it well here. Whether it's renewables, whether it's EVs, whether it's growing the grid, these iterative demand cases are real. And from our perspective, in terms of being an allocator and investing in the space, we really like the dynamic of an existing industrial use case, but emerging new modern economy use cases for these materials.
And maybe I might ask you, I mean, you didn't mention AI, but I would think AI is a huge driver of some of the demand here.
You're absolutely right. AI for sure is a big narrative right now. A lot of commitments being made into growing AI. One way in which AI hits the minerals and adds to the demand case, a lot of the AI requires data centers. We're seeing that in the US, in places like Northern Virginia. The US is a global leader in data centers, and data center capacity is only growing. By 2030, in the US, data centers will be pulling down 10% of all power from the US power grid. The US grid needs to grow, the Canadian grid needs to grow, and the same would be true for Europe. All of that grid growth requires, say, for example, additional copper. Not to mention the additional copper that's required in the data centers themselves. So again, by 2030, it's expected that just the data center, so in data center copper demand, will go up by 500,000 tons a year. And that's separate and apart from all of the additional copper we need for grid growth. And maybe, Cheryl, you could touch on some of the battery energy storage systems that are going to be required also to maintain the grid and manage the grid as we get increasing power.
Battery energy storage systems are obviously required to manage the flow of the power. With these renewable energy systems, we need a place to store and manage that flow. And I think it's a really important part. Today, it's not as big of a demand driver as it's expected to be in the future, but the growth prospects are significant.
That's fascinating. I mean, those facts, especially about the 10% of electrical needs just going to AI and data centers. And you mentioned both data centers in the US and Canada and the needs there. For listeners who can't pick up the accents, you're both Canadian. Now, what happens if Canada becomes the 51st state?
Well, we do not think that is going to happen.
I love it. So we talked a little bit about the why. Let's talk about why you. We'll start generally on why private equity. I think of a lot of these big global mining conglomerates like Glencore or Rio Tinto, BHP, Vale, all these. They're all out there. They're huge. Where does private equity come into this? I would think they'd be pretty well capitalized.
It's really interesting. We take a very targeted approach in the types of assets that we focus on. We're typically targeting development stage projects that are, going through that last stage to construction. And we don't often see a lot of competition from major mining companies in the areas that we compete. Where we do see competition, it tends to be from public markets. So, if you have functioning public markets where there's a tremendous amount of capital flowing into these development stage assets, that can make it challenging to compete. However, what we've seen over the last decade is the exact opposite. There's been a structural underinvestment in these projects. And so there's not a lot of financings that are available for these companies. A lot of generalist investors aren't investing. And we've seen this broadly where a lot of capital has gone passive from being active, and that's really impacted our sector. As we all know, passive capital doesn't invest in more of the small cap companies, which is really what we're targeting to buy assets from. So as a result, these companies that we're targeting have very low cash balances. They are looking for solutions. They are looking for alternative sources of financing. And the reason private equity fits well is because we can take a much longer term approach. Our typical investment time horizon is somewhere between 3 to 4 years. That matches that time horizon, and that duration matches well with the duration that's required to unlock the value at the underlying assets. And then in addition to that, at Kinterra, we have a full team of technical experts. So we have mining engineers, metallurgists, geologists, permitting experts, chemical engineers. And what we do is we leverage that in-house technical team at Kinterra, not only underwrite and select the best assets in the sector, but then also once we own the assets, we typically target owning 100% or having a control orientation. We will leverage that internal technical team to then unlock value at the assets. I think that the private equity structure is actually the best structure in the area that we focus in, which is, again, the development stage projects where there's a lack of capital, there's a need for technical expertise, and there's a need to match the duration of that financing with the underlying technical programs that are ongoing to get to the point of exit.
That's interesting, right? Because you made the comment about public versus private. Public being much more producing, just different risk profile and probably a different return profile as well.
I think that's exactly right, Greg. When you go back and you take a look at all of the data comparing public strategies to private strategies in the space, what you generally find is that the public strategies don't have the same return profile. And the other thing that you find is that volatility in the public strategies is much higher. On a risk-adjusted basis, the private strategy generally looks better if the return's better and the volatility is lower. You know, what I would posit to you is the reason I think the public strategies are difficult is because when you invest in the critical materials, or you have a thesis to invest in the critical materials, and you pick a public team to back or portfolio of public companies, you're still subject to the decision-making of the public company board, and you're still subject to the decision-making of the public company management team. And at times, I would suggest this happens more often than not, the decision-making of the public company board and the management team isn't necessarily aligned with the institutional private investor. To echo Cheryl's point, what you get on the private side, more of an opportunity to vet and diligence whether as an investor, you are aligned with your manager. For a number of reasons, we think our strategy is very much aligned with our LPs, and we can go into, how we invest and the details of the strategy. But I think that's really the real difference. With a public company management team, again, the data just shows the returns aren't as high and it's more volatile, but there's an inherent misalignment there that you can bridge for on the private side.
Yeah, maybe on a generic level, if you could describe how you invest and how you add value.
In terms of our approach to investment, so first off, informed by both mine and Cheryl's 15 or 16 years of doing this and our learnings along the way. And second of all, informed by our analysis of private markets, deal flow and returns. We've looked at thousands of deals across numerous studies, and over the years have gleaned what generates and drives returns in private markets and what doesn't work. There's a lot of data out there. There's skews in the data as well, but we've really synthesized this to 5 factors that inform our strategy. So the first one is watching our entry price. The second one is identifying opportunities where there's real opportunities to add value. There has to be some sort of value creation premise, and we can talk to you a little bit about what it would be in our business. The third is building teams. A failure to build teams erodes returns. We operate within a flywheel. We call it the Kinterra flywheel. It's effectively just the relationships we've built over the last 15 or 16 years in our industry. That flywheel helps us source. It helps us build teams to create the value we need to create. The other thing we try to keep in mind is move fast to exit. Time will erode returns. And the final one for us is insulate against macro and market. What you'll find in a lot of the data is you can never fully insulate from macro and market. But managers who just don't find some way to insulate themselves find an erosion effect on their returns. The way we insulate from macro and market is we try to buy really, really scarce assets in stable jurisdictions that are impacted the least when the market may turn against us, and come back first when the market comes back in toward us. That's what informs our strategy, both our experience and the data from other private deals. Maybe, Cheryl, you can talk a little bit about how we then execute on the strategy.
Yeah. Value creation is a really important aspect of what I think private equity generally focuses on. For us, we split it up into two buckets. So there's transactional value creation and there's technical value creation. This is the value creation during the hold period. Both technical and transactional value creation within Kinterra is trying to accomplish one of two things. One is increase the asset value, which we define in our industry as the net asset value. Second is increase the valuation multiple. We're buying development stage projects. The goal is to buy them sub 0.2 times price to NAV and get a re-rate to 0.6 times price to NAV as we de-risk those assets through to construction. The technical part of what we do is really focused on, it could be land consolidation, it could be restructuring royalties to improve the underlying value of the projects. We could be doing offtake contracts with downstream partners or project financing to de-risk the financing landscape. On the technical side, it's really doing optimization, so mining engineering optimizations, processing trade-off studies, optimizing CapEx and OpEx, and looking at design parameters, doing infill drill programs to improve resources. It's all very technical, but we have, a massive technical team internally at Kinterra who's fantastic, and they execute on all of these strategies to drive value. Our goal is simply to get a fantastic entry price, come in at a low point, identify the high-quality assets with our team, do the heavy lift on all of the transactional and technical work internally, and then ultimately leverage our network in the sector to monetize those projects.
And maybe the ability to buy cheap assets is sort of predicated on, I think of mining, at least historically, being a very boom-bust business. Is that true, or is that dynamic changing as you have these mega trends that are out there?
It's interesting. So ability to buy at the valuations that we want to buy at, I think, is driven by two or three factors. One is a market factor that's applicable to everybody in the industry, and that is the valuations of development stage assets have been negatively impacted over the last 4 or 5 years, adversely impacted. We're seeing a significant decrease and pullback in those valuation multiples, and there's a number of reasons for that. That's because the assets can't attract capital. The companies that own these assets generally tend to be public companies. They don't have liquidity anymore. Liquidity's dropped, something like 78% since COVID. Overall, the capital that these companies used to attract has gone from being active to passive. And when the capital goes passive, they can't invest in some of the companies that are smaller companies that own these assets. That's true for anybody who's looking at the space. It's a market trend. What I think further differentiates our ability to buy at the valuations we're looking to buy at is distress. In our transactions, and this is true in our last fund, every asset we buy, Greg, has some sort of distress catalyst. Whether it's an out-and-out bankruptcy because of balance sheet distress, or it's operational distress, or shareholders may be looking to liquidate after a long holding period. So there's that element of distress that I think helps us buy. And I think the way we take advantage of that opportunity is over the last 16 or 17 years, we've built a transactional tool set that's nimble, it's nuanced. When things get distressed and complicated, we do well from a transactional perspective. If there's a simple deal to do, we probably don't have a competitive advantage. But when things are complicated and an asset needs to be pulled out of a complicated situation through a transaction that may not be the most straightforward transaction, that's where we're going to do well.
Mining, and there's different types of mining. There's sort of big strip, underground, there's, strip being kind of open pit, but it often takes years. That's the problem. I know you tend to come in kind of late stage into development, but you're spending lots and lots of money and not getting production for years. So things can happen in that period of time, right?
A lot of the capital that we're investing in is going into the permitting work. So we do baseline study collections to understand the baseline. What does the asset look like pre-construction and how will it be impacted from construction and operation, which feeds into our permitting work. We have a full permitting team across the US, Canada, and Australia who have been doing this for a very long time. And so that part of it does take time. The technical work takes time. I think one thing I'll point to is when we buy a project, there has typically been 10 plus years of development work that's already been done.
Wow.
Exactly. Right. So starting from scratch is not what we do. We do not do exploration. We're not in the greenfields business. We are in that very last stage of development to take the asset and all of the data that's been produced, all of the work that's been complete prior to our involvement, leverage all of that work, and then do that final bit to get it to the point where it's construction ready, fully permitted, and all the technical work has been done. Typically, we're looking at allocations post-acquisition, depending on the project, somewhere in the range of $20 to $70 million of additional work that needs to be done. But to put it in context, most of the assets that we're acquiring have $100 million plus invested. Our most recent transaction that we did had over $1 billion of capital invested. We bought 2 projects for $128 million. And again, that goes to focusing on opportunities where there's distress, targeting a low entry price, which is a really important aspect of our strategy, and then doing that final bit of work during our value creation hold period to unlock value and achieve our 3 times MOIC.
Maybe going a little bit into basics of what you get out from mining. I think people have this wrong perception, and maybe I did too at one point in time, where if you're doing a copper mine, that you're getting these big bars of copper and they just, you get them where it's not, right? It's like a dirt. What do you get when you mine?
So excellent question. Generally, most mines produce something called concentrate, whether it's nickel concentrate or copper concentrate. It's just concentrated forms of that metal in dirt form. Usually what happens is that the mine will then ship that bag of concentrate to a smelter somewhere in the case of copper. And the smelter is actually the piece of infrastructure that would produce the finished rod of copper, or just outside the smelter would produce the rod of copper that you're thinking about. Now, the reason I think it's such an interesting question, Greg, is that ultimately, from the investor perspective, folks look at the copper price on the screen and say, well, that's the price of the copper. I'm invested in a copper mine. It should be a relationship there. When you're investing in a copper mine, you're investing in the copper concentrate. So what you have to be super mindful of, the relationship between the upstream mine and the downstream smelter and the processing capacity. Now, the very interesting thing that we see on the copper side, and we own 7 projects in our last fund, 3 of them are copper projects in the United States. So we control a lot of copper. We control 13.1 billion pounds of copper. In the US, we are the second largest holder of development stage copper assets, public or private, in the US, in our Kinterra Fund 1. The reason we really like that position is exactly because of the nuance that you're highlighting, the difference between copper concentrate, copper dirt, and the smelters. What's happened over the last decade or so is smelter capacity, the stuff that produces the refined copper, has been built up at a relatively quick rate in China, in India. Now it's moving to Saudi Arabia. Of course, there's smelters. We have smelters in Arizona, in Utah, and Quebec, in North America. But the smelters don't have enough feed. So the smelters were built to be responsive to all of the upcoming demand in places like China and India. The smelter capacity is built, but the smelters are empty. These are pieces of infrastructure that cost billions of dollars to build or have large reclamation liabilities. Nobody wants to shut them. The dynamic we see in the market right now is the smelters are empty. They need dirt. There's just not enough dirt in the market right now. And the way that's reflected in the economics is it used to be that you took your bag of concentrate that you produced at a mine, you sent it to the smelter, and the smelter charged you $80 a ton to process it. That processing fee is called TCRC's, treatment refining charges. Today, those are negative. The smelters are paying you to send them the material. That means you can negotiate better terms. It means you can get the smelter owners to invest in your projects at exceptionally high valuations. Those are the dynamics we try to take advantage of. But again, it's a super interesting question because as a manager in the space, regardless of the commodity that you're purchasing, you have to be attuned to the downstream dynamics because that's your opportunity to further de-risk your asset and create value.
Speaking of risk, I often think, and you mentioned North America, Nevada, places like that, but I also think of mining being these far-flung emerging markets that may be less stable. Do you invest in those types of countries?
So we don't. So our focus is on primarily Canada, the US, Australia, some parts of Western Europe, as well as some parts of South America. I think the important thing to note is when you think about the mining sector broadly, the critical materials and the infrastructure associated with those critical materials to integrate them downstream, there's 4 key risks that we're really assessing. So one is the technical merits of the project. Will it be a mine one day? Technically. The second is the commodity price. There's obviously volatility in the underlying commodity price. There's financing risks. So these projects are capital intensive assets, so they need to be financed to production. And then there's jurisdictional risk. We have no ability to control jurisdictional risk. And so we don't enter countries where we don't feel comfortable that, we won't wake up the next day and not own the mine or have a royalty rate applied to the project that makes it uneconomic. The other 3 risks, this is our job, is to focus on how do we mitigate those risks. So the technical risk is, again, the technical teams and having 16-year history in the business. really understanding the projects and putting the right teams in place once we own those assets. We feel like we do a very good job of mitigating those risks and properly understanding them. On the commodity price risk, when we underwrite our assets, we don't underwrite our projects with the assumption that the commodity prices are going to go up. Our view is we look at long-term consensus, which is generally in line within a range of where we are today. Even though we see these tailwinds from a supply-demand fundamentals perspective on the commodities we are investing in, we assume long-term consensus commodity prices. In addition to that, we also, in our best efforts, try and structure offtake contracts downstream and integrate our assets upstream into the downstream. On the financing front, which is the third risk, we look to export credit agencies to provide project financing. That landscape has completely changed. This goes to the dynamic of friendshoring, where there is a focus on creating secure supply chains. And so export credit agencies, part of the OECD arrangement, are providing project financing for projects in the jurisdictions that we invest in on favorable terms. So we feel technical commodity financing risks we can manage to the best of our ability with the skill sets we have and the experience we have, and the networks we have and the teams we've built. Jurisdictional risk, we cannot. And so we tend to focus in stable jurisdictions. In our current fund, all of our investments are in Canada, the US, and Australia.
You mentioned friendshoring. And Kamal, you talked about the smelter capacity, and a lot of it is in China. We actually sometimes mine, ship it to China, they process it, and then we buy it back or bring it back in a different form. As the world splits among kind of east-west lines, is that an issue? Do we have enough capacity in friendly countries to process all of our needs?
So I would say from our perspective, Greg, that's the opportunity, because what you've described there is the realities of the market today. Extraction is done outside of China. It's done inside of China as well, but the mining is done outside of China. Depending on the commodity that you're thinking about, 65 to 90% of the processing capacity is done in China today. And the risk that the governments are increasingly attuned to, and the current administration is no different. I was reviewing some of their key points going into the new term, and taking more control of mineral extraction, the critical minerals, and processing is right near the top of the list. But it's not just the US government. Other folks, and not just the government, industry is becoming very attuned to this as well, because the real risk is we send stuff there and they decide not to send it back. And we see that in germanium. We've seen that recently in gallium. Refined graphite now is on a review list of whether it should be exported out of China. And you cannot secure supply chains with that sort of concentration risk in your supply chain. And so that is the reality. That's what we're trying to solve for. I think there's a lot of stakeholders that are trying to solve for that. My personal view is I don't think that's a public market solve. Building these supply chains and the processing, it's complicated. It's not necessarily best understood by the public capital markets. Our take on it is the solve probably lies in some sort of partnership between industry, government, and private capital. And that's where we see the real opportunity is friendshoring and repatriating those pieces of processing infrastructure. And the more we can do it with support from our downstream industry partners, but also support from governments who want to see the infrastructure repatriated, the better.
Can I ask a further question on friendshoring? We were joking about this earlier, about Canada being the 51st state. What you're definitely seeing the new administration push back on foreign competitors, but also pushing on what we would consider our friends, our allies, our neighbors. I consider you friends and neighbors.
Feeling is mutual. Thank you.
Is that a risk? Will there be tariffs put on Canada? And when you go back and forth between US and Canada, prices get put out of place.
Whenever we think about the tariffs, we always try to separate the rhetoric from what will ultimately be the policy. Even going into sort of the recent inauguration, there was a lot of talk about day one, there's going to be tariffs. And of course, we're recording this after the inauguration. That didn't materialize and didn't come to fruition. I think undoubtedly, whether it's from a US perspective, a Western Europe perspective, Canadian perspective, we are living in a more protectionist society. That is for sure there. But in terms of what actually is subject to tariffs, which commodities are subject to tariffs, which chemicals are subject to tariffs, I think we'll just take a wait and see approach on what the actual policy says, as opposed to where their rhetoric is. And what I would posit to you is that ultimately, whether you're in Canada, Western Europe, and the US, we need these materials to build key supply chains. I think some thought and prudence will be given and deference will be given to the fact that it may not be in anybody's best interest to put exceptionally high tariffs on the very stuff you need to build secure supply chains in the US.
Like, what if we slap tariffs on hockey? I think that would break you guys.
I think that might be a tough one. I don't know what the NHL's ratings are right now in the US, but if there was a tariff on top of that might be tough.
Talking about other risks, and we talked about friendshoring and all of that, but just China, right? I mean, if you think about a lot of commodities, there's a global price. Right? There's a global price for oil. There's a global price for copper. And they may be listed at different exchanges, but they all impact each other, right? Is there a risk that a slowing China, just from overhang from their multi-decade infrastructure boom, slowing demographics, that a lot of these hopes and dreams for commodity demand, commodity pricing goes away? Is that a possibility?
Yeah, so it's an interesting question. I think if you look at China's consumption of materials generally, critical materials included, it has been significant, obviously, stating the obvious. One of the interesting statistics recently that we came across on copper specifically is a significant portion of copper demand in China is actually going into building out their power grid. So China has done a fantastic job of getting consumers to shift their preferences to driving EVs. I think they have 50% adoption today, and China represents a significant portion of EV demand globally. That really, in parallel with their focus on building out the renewables space as well, as driving the demand for electricity, which is driving the need to increase their power grid. So the portion of consumption of copper is actually increased significantly to build out that grid. And I think from that perspective, we can see that that need is there. And we can see that although we have seen a slowdown in China, it's not having as big of an impact as you would have anticipated. When you layer that on top of what's happening broadly with the modern economy, and again, the modern economy is all-encompassing. It goes back to the AI, data centers, draw on power, renewables, BESS systems, EVs. And in the developed world, that demand profile is significantly increasing. So broadly, when you look at kind of everything that's happening on the demand front, and then you couple that with the lack of supply coming online, the fundamentals for commodity price support for the materials that we invest in is still there.
I agree with Cheryl. And I think just unpacking that a little bit more, Greg, what I hear in your question is on waning China demand. And I agree, it's just that the nature of Chinese consumption has just moved away from property development to infrastructure. The interesting thing in your question is ultimately it's a demand side question, right? What if something happens and your demand side is impacted? The way we think about that as a manager is to contemporaneously also focus on the supply side story. So for me, the risk that you're highlighting, going back to the 5 factors that we think about when we're making private investments, is you're introducing a market shock into the equation. And one of our key tenets is to insulate yourself as much as you can from market and macro. And the way we do that is, for example, with copper. On the demand side, I agree with Cheryl that in addition to China, you have the modern economy story, you have the other emerging markets coming online. But if you assume that there was a market shock on the demand side, contemporaneously, if you're looking at the supply side of copper, there are structural supply issues on the copper side with new mines not coming online, disruptions in Latin America, in Chile and Peru that continuously impact copper supply. And so when we think about investing and we think about insulating from macro and market shocks, we're always paying attention to the demand side, but then we're looking at the supply side to see if there's something structurally that challenges the supply for a project. And again, supply and demand are just 2 items you look at. We're trying to consider as many factors as we possibly can that drive asset scarcity.
I love that. The great point about supply, and Cheryl, also a great point on demand that, okay, maybe copper used to go into building an apartment building in a second or third tier city. That copper is still needed to build out data centers or their EV grid. And so it just may change where the demand is.
Exactly.
All right. Paradox question for you. This is a tough one. Is this kind of an ESG strategy? Because here's the thing. Energy transition needs all of these critical minerals. But to do so, you're digging a giant hole. So how should investors think about this?
It's very interesting. And again, we've been in this business now for 16 years in private equity focused on mining assets. And if we go back to the beginning of our time, we were always very focused on the environment, and we were always very focused on having a social license to operate. In the segment that we participate in and invest in the mining space, in development, you absolutely need to be focused on the environment. You need to be focused on what's happening in the communities, and you have to have great governance practices. So that has been consistent since the very beginning for us. The ESG narrative, obviously, in more recent years has developed in a different way. And I will say that has not changed our practices. We've always adhered to really, really strong ESG practices. Again, pre-ESG narrative, this is just what we do to drive value on our assets.
And it's at risk too, right? If you have an environmental accident, there's a cost.
Now, we're not operating assets, so we tend not to have those risks associated with our projects. Our risks are more, do we have community support? Can we get the social license to operate? We deal with Aboriginal communities in the United States. We deal with First Nations in Canada and traditional owners in Australia. We want the support of the communities. We see them as long-term partners and stakeholders, and that is a path to getting our permits on our projects. Getting permits on our projects is a major de-risking event, and it also drives value. And so when we think about what is our approach on ESG, it's really about driving value. It's about engaging with communities. It's obviously focused on the environment, which has always been a really important aspect of what we do. The other part of your question is interesting. Of course, right, we have to dig big holes or put underground infrastructure in place to extract materials and process. The difference with the mining sector and the critical materials that are being extracted is once they're extracted, they can be recycled and we can create a circular economy. And we cannot do that with fossil fuels. I think that is the big difference. Of course, there's an impact upfront. That is true. And you have to do what you can to manage and mitigate those risks. That is our job in designing these projects to be constructed. But beyond that, once the material is out of the ground, copper is a great example. 25% of the copper market today in the supply side actually comes from copper scrap. Batteries, all of the materials, lithium, manganese, cobalt, nickel, can be fully recycled 100% of the battery and reused again in the next battery.
And steel's like that as well, right?
Exactly.
Yeah.
Exactly. So I think broadly speaking, some folks will identify this as, you're still destroying the earth. And of course, the extraction element does exist, but doing it in a sustainable way, a responsible way, focusing on the communities in which we engage with that are all stakeholders. And then broadly speaking, this is, again, the narrative around the circular economy and the recycling aspect of it.
I agree with Cheryl, Greg. I think the only other two things I would offer on that is from an investor perspective. How should investors think about it? Our experience has been disparate. I think some folks in our investor base, at least, and the folks we dialogue with, they view the Kinterra strategy very much as a exposure to critical minerals for energy security purposes. And that's the opportunity that they want us to go out and deploy into. And for other folks, it's for sure energy security. And then there's an ESG component on top of that. And I'll just echo what Cheryl says. I think the recycling part of it is very key and a key part of the narrative. But beyond that, it comes back to our jurisdictions as well. We're developing projects in Canada, the US, Australia, Western Europe. We're subject to pretty stringent guidelines. And it's probably one of the reasons why we haven't gone to some of the jurisdictions that our peers have. First, again, as Cheryl has previously mentioned, we don't know how to underwrite the risk in those jurisdictions. And second, some of the human rights and sustainability standards are questionable there.
To kind of sum that up, you are environmentally aware. You're going to manage the environmental risk, but you yourselves, to be very fair, are not holding yourselves out as this. Some people may classify you one way or another, but regardless, you feel some responsibility because it's the right economic thing to do to make sure that these projects are maintained.
Exactly.
It's a tough question. I don't want to make sure that, you're not greenwashing or anything like that. But I get this question a lot is like, where do you put it? Is it a good thing or is it a bad thing? And it's probably a little bit of both, like anything, right? There's an impact on the environment, whatever you do, right? Mm-hmm. So you have to properly manage it. And I know you're not in production, but Cheryl, you said that there isn't as much of an environmental risk. Are you indemnified? Like if you buy into a project and for some reason didn't realize that there were some issues happening, are you in the hook for that? Is that a potential risk?
It's an excellent question, Greg. And anytime you buy a site, except under very, very limited exemptions, you generally take on the liabilities that are at the site once you're the operator. And again, there are some limited exemptions to that, but that's an in the main statement. Look, we've been buying these assets and investing in these development stage assets for now 16, 17 years. We have a comprehensive environmental DD process. We get into the deep dives of not only sort of the types of environmental issues you would expect, and kind of soil quality and things of that nature, but beyond that, First Nations issues, archaeological issues, flora, fauna, endangered species issues. We have a full team that gets into those issues. And so we generally go into our projects pretty aware through a comprehensive due diligence process on what we're buying. And thankfully, in the last 16, 17 years, we haven't been surprised by any environmental issues after the fact. Now, I do think that that is a much more simple process on a relative basis than if you're buying the producing assets. And again, another reason, aside from commodity price volatility and things of that nature, that we prefer development stage assets as opposed to the producing stuff.
I always think this is fascinating, learning about an industry and kind of where stuff comes from. To my point about maybe thinking that copper bars just kind of popped out of the ground. And if there are other listeners out there that are a little bit like me that want to learn more about this, are there any good resources or books that you would recommend?
It's a great question. I think that the way that we think about resources to look at these types of opportunities, we've had a conversation recently with one of our investors, and they said, I went to ChatGPT and I asked the question, why invest in critical materials and how do I invest in critical materials? I think that kind of starting from those places, YouTube, ChatGPT, just as a baseline to get the foundation, I think is really helpful just to kind of formulate views on where the opportunities exist and then how to go about deploying.
What I would share with you is that I always find that you're only going to learn so much through reading a book and doing research on your own. I think that's table stakes. I think for sure folks should get research, and ChatGPT certainly makes it easier today. But I think what I would share if somebody's trying to get up the curve is there's a lot of seasoned, experienced institutional investors in the LP community in the US that for years and years have invested in the space, have lessons learned from the space. We certainly have lessons learned from the space. My advice would be after you do some initial baseline reading, start talking to people. Go out, get to the conferences. There's the PDAC conference up in Toronto that happens annually. Other global conferences on critical materials. There's many, many conferences on that. I would start talking to some of the other folks in your LP network on the real asset side who have exposure to the space. And I think there's a wealth of knowledge there. We certainly have come across those folks in the last 10 or 15 years. And really, really importantly, I think we're going into Gen 2 of mining private equity, kind of leaving Gen 1 behind. And I think the really interesting thing is I think those folks that live Gen 1 will tell you everything they're looking for in a manager for Gen 2 through some of the lessons learned from Gen 1.
Those are great suggestions. We're kind of nearing the end. I usually ask some fun facts. I'm going to give you some options. A personal fun fact, and it has to be interesting. Sometimes get facts that are really not even facts and they're not fun. So it has to be a fun fact about yourself, mining, or if you just have a really fun story about being in the mining industry that you want to share. Either of you can start.
Okay, I'll kick it off. I have a fact.
Okay.
It's a good one.
All right.
It's a good one and it's an important one. It's a meaningful one. It relates to today. It's fun in the sense that the outcome was really positive, but it's a fact about me. I'll share personally. Today is actually a 16-year anniversary of being a living liver donor.
Oh, wow. Okay.
I was selected to be a living liver donor for my 2-year-old niece, who is exceptionally healthy, first-year university, studying to be a doctor. I'm super proud of her. And today is our 16-year anniversary.
Oh my gosh, that's incredible. And that's an awfully high bar.
No, there's, I can't follow that. I'm going to keep it super light. My fact's not so fun, but it is a fact. And Cheryl, I'm refusing to follow you ever again. My fact about me is I am a big, and anybody who knows me knows this, I'm a big supporter of Liverpool Football Club.
All right. Never walk alone. Is that the...
You'll never walk alone. Well done, Greg. That is my fun fact. I actually usually get out to a game once a season with my son when their stadium's called Anfield. I'm going to bore you guys about this because you've asked now.
I like the EPL.
Their stadium's called Anfield. It's this magical place. I actually have a stone that I bought for a couple $100 that has my name on it, my 8-year-old's name on it, and you'll never walk alone. I don't know if anybody, follows English football, but Liverpool's very much an underdog city, a gritty city, and they all kind of assemble around this anthem of you'll never walk alone to persevere and punch above their weight. And the reason I brought that up is, that's kind of our culture at Kinterra.
Oh, wow. Huh? Bringing it full circle. I'm a Tottenham fan.
Oh, no.
Our motto should be maybe you may never win again. That might be.
They're getting close to the relegation. I just looked at that recently. But yeah, that's kind of what we bring to the Kinterra side is focusing on perseverance and focusing on doing things, big things as a collective team. And so a little pull from the LFC culture.
Any fun mining story we can end with? Any like
okay,
crazy?
I'm going to share something with you. Right. You pulled it out of us. This goes back a few years. We had a prospective LP come to our office in Toronto, and we won't name them. They were ex-North America, ex-Europe. Let's just put it that way. Did a couple-hour meeting in our offices. Our offices are General Office Tower, as you might imagine, in the downtown financial core. 2-hour meeting, it's going well. There's the whole team there. We talked about deal pipeline, all the usual stuff you would cover, origination, value creation, deal pipeline, monetization. Wrap up the 2 hours and we're like, okay, guys, do you want some lunch? They're like, no. We actually just want to see the mine.
It's on floor 5, right?
They said to us, is the mine just not downstairs under the building?
Oh my gosh.
And so we had to tell them that our mines are actually in pretty remote places. That's what I could come up with. I don't know, Cheryl, if you have any others.
I don't have any others. That's probably a pretty good one.
What about someone thinking it's like a miming strategy instead of a mining strategy? Would that be?
We haven't had that.
Never had that.
No.
All right. Well, hey, thank you both. This has been fascinating. I've really enjoyed it. And I know you said it was your very first podcast. You're both very good. So don't make it your last.
Thank you, Greg. We appreciate the invite. This has been fantastic. And hopefully we can do another one at some point.
Thanks so much for having us.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.